Hey everybody, it's Larry Berman here, coming to you live from the City of Lights in Las Vegas, Nevada. I've got my VIP pass here, here for Super Bowl long weekend and for a little bit of fun with some of the boys. And let's dig right into the chart room and see what we learned this week. We've got CNBC on in the background here, the hotel in Vegas that I'm in right now. A little bit after the market close on Friday doesn't have Bloomberg. So I'm stuck with this guy. It's not my favorite channel, but anyways, point being, they had one of their guys on looking at market breadth and showing the decay in market breadth. So I thought that would be a very interesting talking point this week, because it is clear, you hear out of Wall Street and the talking heads that the market is broadening out. So when you look at it from this perspective, you see a little bit different story here. So this is the percentage of stocks in the Russell 3000, broad US benchmark, large, mid, small cap stocks all the way down. Percentage of stocks above their own 200-day average, so long-term trends being positive, okay? And you can see coming off the 2002 low at that last capitulation point prior to COVID, prior to the end of 2018, prior to that before the beginning of 2016 and so forth, where the vast majority of stocks were well below their 200-day average and the markets were extremely oversold. And then I've put in a linear regression. So that red line across the middle is about neutral at around 50 in the long run. And then you have one standard deviation and two. It's rare in a bullish scenario that we get beyond one standard deviation to the top side. So the overbought condition that came in 2020 off the COVID bump was massive. And when things get bad, two standard deviations or more to the downside. So that's a very, very real thing. So let's blow this up again and look at it in a shorter window here. And look at and try to understand market breadth for all of 2024. So generally speaking, 50% or higher. So within neutral to one standard deviation, good market breadth, and that's where more stocks are participating in the rally. We go back to the US election here in November. We get a market thrust. All will know we broke out to the upside in a lot of the indexes. Small and mid cap started to rally. And then again, we got a little bit overbought. And really, ever since markets have been consolidating, and more recently with concerns of tariffs, we saw a really big, decay there. And so that's a very real thing here. Should we break the lower end of this bound and start to see the market, on average, more stocks trending down and up above a longer-term average, that would be a sign that, markets are breaking down. So, what's going to be the catalyst for that? Because again, here's the same U.S. equity picture, U.S. election pop, a lot of rotation. This is the Powell hawkish. Markets tested the election gap. We held. We can't break out. Every time we've tried higher high, failed. Tried, failed. Again this week, tried 6,100 plus and failed. Don't know if it's going to break down or up, but here's what needs to happen in my mind for this to break out or break down. So let's go breakout. Earnings have been great. Market needs to keep rising on earnings, and earnings expectations are high, but we still managed to beat them overall, but narrowing. Okay, so that's an important message here. Earnings breadth is narrowing this quarter. Some sectors okay, but generally narrowing. Break to the downside really has a lot to do with policy. So enter Scott Bessent, does an interview this week. He talks about the US 10-year and its importance, and everyone says, they're going to get the deficit under control, and Doge is going to do its thing, and you get a bunch of short covering in the bond market, squeezing the long end higher. I think this is a very important thing here that Bessent's trying to do. He's trying to get President Trump to stop yelling at Powell for not cutting rates, because inflation and inflation expectations are rising. We saw it in the Michigan numbers on Friday. There was a catalyst for the reversal, because early in the day it was up. When that data came out, markets turned around, closed down hard on the day. Investors were surveyed. Americans were surveyed, and they think inflation expectations are going to go up largely and almost exclusively due to the tariff talks. So that is a big, big issue. And the Fed will not be able to do anything about it. That if inflation expectations start creeping up, they're going to have to raise rates. I don't expect they want to do that or should, but that is the risk. So the president will look stupid if he yells at Powell for not cutting rates, because that would only goose inflation and get us focused on the 10-year, because that is the colossal debt and deficit that Doge and everything else is trying to fight. So I think the eye is on the right ball now. And so TLT becomes a very important trading vehicle. And so the cost of long-term money is going to have, or should have, a big influence ultimately on whether the S&P breaks out to the upside or downside. And that's kind of what we learned this week. And so which way is it going to go? For now, it's range bound. I wrote some calls on TLT for June. Taking in some premium at 95. I don't think we're going to see that. If we get a hard economic landing, we're north of 100. So I don't see that in the span of the first half of the year. But if that risk prevails, that is what's going to break the bond market out to the upside. But that will really hurt equities because it's economic weakness and therefore a hit to earnings that's driving that. So bullish bond market isn't bullish stock market. This year and beyond. On the other side of that, higher interest rates are probably not in the cards. We think the focus on the long end and really trying to get that annual deficit towards 3% from the current 6-7. I don't think it's doable, but without more drastic cuts, and I don't think that that's politically possible. So we'll see how that all plays out as they get into Q2 and the debt ceiling comes to the 6 o'clock news again. Anyways, interesting week. I got my Buffalo Bills shirt on 2 weeks ago. That was the Super Bowl, and the Bills lost yet again. Go KC.